My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll do it, my friends. I'm just trying to make a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. You stray, you lose. That's the defining feature of this market, because if you stray from a small portion of the tech complex, you are going to be destroyed. Today, very difficult. Dow shed 51 points. S&P ended up 0.07%. The NASDAQ advanced 0.32%. There it is again. We spent a huge amount of time talking about a very narrow group of winners, some of which you might be lucky enough to own. Information technology sector up 34.8% for the year, led by, yes, NVIDIA, the king, up 174%. AMD up 93%. Salesforce up 65%. The communications services sector up 32%, this time driven by a handful of winners like Meta Platforms up 118%, Alphabet up 40%, Netflix up 33%. Third, there's the consumer discretionary group. That's rallied 19%. It's led by Tesla, up 63% for the year. It's a who's who of artificial intelligence and friends of cornucopia of companies that benefit from extremely fast semiconductors, just a small smattering of winners amid a host of losers. In short, this is indeed the subterranean homesick market, because you don't need a weatherman to know which way the wind blows. Yes, it is that narrow. And that's why I want to break out. I want to do something very different from what you heard all day. Today I want to focus on not just the winners, but the losers. The losers, the raggedy rest, to show you what happens when you do stray from tech and what you end up in. More important, explain why so many sectors have become minefields. Let's go through the S&P 500 sector by sector. Energy is the worst performing group. It's down 11%. Easy to understand why. Both oil and natural gas prices have been obliterated this year, including one more horrific day today. So, of course, the fossil fuel stocks have been killed. It would be weird if they weren't. Apache down 31%, Halliburton down 24%, Devon down 24%. Next, the utilities, which do poorly when interest rates go higher, because they tend to be dividend stocks, and these dividends now look less attractive versus bonds. Utilities are off 9% for the year on average, led by AES, distribution company, down 31%. Dominion, a traditional utility, down 18%, worried about the dividend. Eversource, another utility in the Northeast, down 19%. Normally, the utilities are terrific recession-proof stocks, but if you invested like the Fed's going to throw us into a recession, as so many say, you've been crushed in these stocks. Healthcare, right in the crosshairs of the government, down 7% for the year. Oregon led the way. That's the women's health spin-off from Merck. It's off an astounding 31% for the year. Then there's the great Moderna, down 28%. Hey, post-COVID hangover. CVS, same problem, off 28%. So much for its diversification to other forms of healthcare beyond the pilferage cursed drugstore chain. I'm actually shocked that the financials are only down 6.5% for the year, given that the regional banks have been disasters. Comerica down 44%, KeyCorp down 43%, Zions off 41%. These are all casualties of the collapse of Silicon Valley Bank and First Republic. This group is so bad, you ought to wonder if they can even bottom when the Fed finishes tightening. So far, the only financials reflect the bad, not any good. And so the yields are unsafe. The earnings are clouded by supposedly inevitable recession, though that recession never seems to arrive, despite the Fed's endless rate hikes. Waiting for Godot's situation. Real estate, off 3.5%, heavily influenced by the persistence of remote work. Big office building owner, Boston Properties, down 28%. Alexandria Real Estate off 23%, and then a host of others jockeying for third, too close to call. It's another cursed group made even more painful because the real estate investment trusts used to have trampolines of high yields underneath them. But with interest rates so high, especially on the short end, those dividends offer very little protection. What can I say? Businesses just don't need as much office space as they did before COVID. Not with so many people working from home a day or two every week. Next, we have the consumer staples. They're down 3%. Archer Daniels Midland, agricultural processing company, falling 23%. You think Archer Daniels would benefit in an environment with so much inflation, but when you drill down, the worst inflation is in housing and wages. Everything else has cooled, in some cases dramatically. Then there's Estee Lauder, which we own for the Charitable Trust. Hasn't been good lately because their fortunes are linked with China. China's been a disastrous theme, as the reopening's gone much slower than expected. Finally, there's Walgreens, down 20%, which is frantically trying to imitate CVS's decision to go all healthcare, not just pharmacy. Horrendous results so far. To be fair, it's not liking their plans. Look, they can't do any better than CVS. Then there's the materials sector, down 2.7%. That's led by CF Industries, a fertilizer stock, off 27%, followed by the once pristine International Flavors and Fragrances, which has been decimated by bad management, causing its stock to fall 25%. And then there's another fertilizer play, Mosaic, which has lost 24% of its value. The FERTs, as they're known in the business, have been stalwarts of the great agricultural boom that occurred when Russia invaded Ukraine. Breadbasket of Europe. 13% of the world's calories went offline. Once the ag supply chain got sorted out, though, the group collapsed. Finally, we've got the accursed industrials. They're off 3.5%. The worst is a company called Leidos. That's a government consultant that many consider to be a very smart defense company, down 25%, thanks to fears that there might be defense cuts in the debt ceiling deal. Next is 3M, which has 2 giant lawsuits against it, causing it to fall 20%. 3M's fabled dividend aristocrat status hasn't deterred sellers. And then there's Northrop Grumman, also off almost 20%. That, too, is about the budget deal, I call it the non-deal, with investors fleeing from defense contractors for fear of spending restraints. Now, when we look back at the first 5 months of the year, we can only conclude that if you wandered away from the very small part of tech that's a funnel, you underperformed. All of this is to say that 2023 is the turbocharged opposite of last year. The market's so narrow that if it weren't for ChatGPT and the recognition of what artificial intelligence could be worth, the averages might be having a terrible year. As it is, tech so strong that it's allowed the S&P 500 to rally 9.5%, even as not much else is working. In fact, if you looked at an equal weighting of the S&P, where the return on every stock has the same contribution to the index's performance, you'd have a down year, down 0.35%. It's arguably the best year if you're a tech investor, or the worst year if you're concentrated in anything else. It's so bad that you have to wonder if this disparity can really continue. We trimmed some tech this morning for the Travel Trust. You can look at our reasoning by joining the CNBC Investing Club, and I urge you to do so. The bottom line, we just feel too darn greedy not to take any profits in tech. That said, though, straying from tech might continue to be the kiss of death in this market, at least until we get a cooling in the trillion-dollar colossus that is NVIDIA, the undisputed leader of 2023. Tyler in California. Tyler.
Hey, Big Booyah from California. How you doing, Jim?
Booyah, back at you, Tyler. What's going on?
Real quickly, I'd like to give a shout-out to my son, Landon. Daddy loves you. My question is regarding Salesforce, CRM, going into earnings. How's it looking?
Okay, I think that Salesforce has a really bright future because of what's known as Einstein, which is their predictor that uses a lot of artificial intelligence. So I actually think that even if it isn't good, I'd like to add to the position that we sold if it gets really hit. We have a nice position in the Travel Trust. I still expect good things out for the year. Let's go to Mike in Illinois. Mike.
Hey, Jim. Thanks for taking my call. I'm calling in regards to Portillo's. I'd like to know your opinion on whether or not the stock is worth buying.
All right. Sure. I mean, look, I'm going to give you 2 answers. One, the company is worth investing in. But 2, the shareholders who were part of a private equity, private going public, have decimated the stock. They've got to stop selling. They have to. That stock could be at 30 if they would just stop selling. Look, straying from tech might continue to be the kiss of death in this market. We still get a cooling in the trillion-dollar colossus that is NVIDIA, the undisputed leader of 2023. On Mad Tonight, last week, while all eyes were on Cramer fave NVIDIA, there was another semiconductor player that wowed Wall Street with its AI plans. Don't miss my exclusive with Marvell Technology. Learn more about what's in their pipeline as the stock continues to be on pace to have its best month since 2001. Then, I've been telling you that I think there's a good chance that Wall Street's being too negative here. So where should we go to get a read on the prospect for economic growth? I'm going off the charts on a precious metal that's not as precious, that's more of a industrial metal. And HP reported after the close. And with a host of headwinds facing the PC market, how did the company fare this quarter? I'm getting the latest from the CEO, and it's not what you expect. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.